YouTube's kind of like crypto. Anyone can produce videos. Right? The vast majority of stuff on YouTube sucks. There's incredible talent hidden within YouTube that would never gotten discovered. You almost need all the crap. The process of discovery is just failure. A crypto token you can create at the same time to create a YouTube video. The expectation is going to be that it's a feature, not a bug, that there's a lot of bad experiments, but there are extraordinary experiments buried in there.
John D'Agostino is the head of strategy at Coinbase Institutional. After decades in traditional markets, he says crypto isn't just another asset class, it's a shift in how markets operate. While price action still reacts to macro and liquidity, institutions are steadily increasing exposure and building infrastructure behind the scenes. Do you think that institutions are overwhelmingly concentrated on Bitcoin?
I think Solana gives Solana credit. I think part of the reason you're seeing exchanges deep dive and go directly into building side-by-side parallel tokenized equity trading on blockchain, I think we have to tip our hats to Solana. It proved the resiliency of the infrastructure.
Yes. John D'Agostino.
D'Agostino, yes.
And it is Italian.
It is Italian, yeah. It's a supermarket chain here in New York.
Really?
Yeah. It's kind of getting a little long in the tooth, but it's a kind of a classic. There used to be this TV commercial growing up I got teased about that was very, very popular. So all through my entire childhood, I was just mocked relentlessly for this like over-the-top dramatic New York City-centric TV commercial about the supermarket chain.
Oh, wow. Yeah, because it's your chain. That makes sense.
Distant family, but yeah.
So for those that don't know, John, you sit at the intersection of traditional finance and crypto, working directly with hedge funds, asset managers, some of the largest allocators in the world. You spent decades in institutional markets, and now you have a front row seat to how capital's moving. So I'm really excited for this interview personally.
I'm excited to be on with the blonde broker.
Oh, thank you. I have a lot of questions, but before we get started, I kind of want to start a bit higher level before we zoom into crypto specifically. We've seen in this environment where everything from equities to crypto feels heavily driven by macro forces like rates, liquidity, and obviously geopolitics. Do you still view crypto primarily as a macro-driven asset class, or is it kind of starting to decouple and trade on its own fundamentals?
That's a fantastic question. And I think the decoupling notion, look, before the show, we were talking about your background, and you have extraordinary background. You worked on the floor.
Thank you.
You've been around trading markets for a while. You mentioned this wonderful period in your career where you decided to branch out and start trading low volume stocks. So you're very familiar with how emotionally driven, even fundamentally driven markets can ultimately be. And markets couple and decouple all the time. Right. So my background's the commodities world. And I used to always get mad at the folks around me if they say, oh, you should invest in commodities because they're non-correlated to fixed income and equities. Yeah, until they're not. Mm-hmm. And they're not at the worst. Exactly when you need that lack of correlation to hold, that's exactly when they're not going out. Right. So if you just back up like 10,000 feet and just look at kind of how market structure and market participation has changed. And I hate using jargon. So market structure is just a fancy term for the plumbing, the rules of how things trade, and all the firms trading them, and what that all adds up to. Over the last 20 years, we've seen the vast majority of order flow for virtually all assets: equities, commodities, fixed income, credit, munis, everything. Be strongly dominated by a small consolidated group of very large trading firms, market makers, high frequency traders. They decide what the correlations are ultimately. So we can argue and say, oh, Bitcoin's not a risk trade right now, risk on, risk off. But when you're in a dramatic geopolitical COVID type 10 sigma event, everything is a risk on, risk off trade.
Right.
With the exception of a few defensive positions that people kind of lean into. So right now where we are, there was a great decoupling occurring, I'd say about 6-8 months ago. We saw Bitcoin as a leader and then crypto in general being decoupled from the risk on, risk off tech trade, and a return to the core principles of what makes an asset like Bitcoin really valuable. I understand people's frustration right now because they're like, well, look, we have this geopolitical shock. This is exactly when assets like Bitcoin and gold should be outperforming.
Exactly.
They still kind of are relative to the S&P, absolutely. And gold outperformed for a brief period of time. In the last couple of weeks, we've seen Bitcoin materially outperform gold and the S&P. But the next follow-on question people always ask, wow, but how come it's not rallying tremendously?
Right.
because order flow is largely controlled by a consolidated group of trading firms. Those trading firms react in concert, and everything becomes risk on, risk off during these periods.
Okay. So I guess in terms of institutional positioning, then when we think about macro, it's coming down to that positioning, that capital flow, like you mentioned. There's been a lot of talk about these institutions coming in, but sometimes it doesn't really feel like we're seeing aggressive deployment, which I guess would be right now.
Yeah.
From your vantage point at Coinbase Institutional, are institutions actually putting capital at work right now, or are they kind of still waiting on the sidelines? And I'm guessing maybe it's because of the act.
So when we talk about putting capital to work, I think what a lot of people, their mind goes to just investing into the market, buying Bitcoin. There's another way to put capital at work, which is hiring and building infrastructure. So both those things are happening. The capital deployment is happening. It's not happening as fast as people want, but there is a steady increase in net exposure to crypto in all forms, including Bitcoin. That's without question. Not as fast as I think a lot of people within crypto would like to see, but it's absolutely happening. More sovereigns are buying, more central banks are adding to the balance sheets, more individuals are entering the market. Morgan Stanley actually announced their ETF, which Coinbase is a custodian for. You're going to have an army of brokers now able to, keep in mind, the Bitcoin ETF was the best launched ETF in the history of ETFs, and no brokers were allowed to pick up the phone and sell it. You know this from your history. These products are sold, not bought. Most average Americans with an investment account and retail broker access do not pick up the phone and call their broker.
Oh, absolutely not.
And say, I want to buy something, right? It's the outgoing calls. Bitcoin was off the table for that. And it was still the best performing ETF. That's like finding out that Labubus were illegal and they still became
They should be
the best selling. I got my daughter loves them. So now we've got Morgan Stanley entering the fray with this the thundering herd of brokers. You've got the ability to sell that product. So that's happening. Capital deployment in the form of infrastructure build out and hiring is happening like crazy. Tons of open jobs at all these firms that have been deriding crypto for head of crypto roles. I've gotten the phone call from at least 5 of them. Our CAS product, crypto as a service, which allows a company with any sort of retail consumer base, no matter what they do, to offer crypto services on a white label basis using Coinbase's infrastructure. Hundreds and hundreds of companies in the queue. Hundreds and hundreds of clients already. So that capital deployment, which I understand is not as sexy, it's like building the bridges and the tunnels and the subways. It's not as sexy as like the storefronts that you see. That is happening faster than it's ever happened, regardless of capital deployment into the markets.
Okay. I think my thesis, I guess I was just assuming it was everyone waiting on the Clarity Act, and we'll get this question out of the way.
Sure.
But before we get into this, I just want to break down what the Clarity Act is for my audience that might not know, and they might not be paying attention or following the news. The Clarity Act is essentially trying to define how crypto assets are regulated in the US. Right now, there's still a lot of confusion around what's considered a commodity versus a security. And that uncertainty has basically made it harder for institutions to fully participate. What this bill aims to do is to create a clear rule around who regulates what and how digital assets are classified and how markets can operate in a more structured way. But at the end of the day, we know that institutions don't move capital under unclear environments. So with that context, if you had to explain what the Clarity Act, I guess, is in simple terms,
Sure.
What does it actually change in crypto?
So it's a really important concept, and you did a phenomenal job of explaining it. I'll go even simpler. If you think about something like Genius versus the Clarity Act, it's the difference between a local municipal law, like around jaywalking, and a constitution of a country. Market structure is the constitution. It is the overriding rule set that determines everything. It is massively, massively bigger and massively more important. When you hear the term regulatory clarity, which I hate, by the way, because I think it's an excuse. I mean, there's no such thing. Like equities don't have regulatory clarity. Like I can name you 50 things that we do with billions of dollars that if you put 10 lawyers in a room and ask them, can we do this or not? 5 would say yes, 5 would say no. So this notion of regulatory clarity is a bit of an excuse. However, what you do need is something to reference. right? Even if you disagree on the rule interpretation, there has to be a defining document, right? You can't have a country without a constitution or some type of governing document. You can't launch a company without a defining document, right? But companies get sued all the time because some people believe you should be doing X when you should be doing Y, right? You can argue about it, but you can't exist without the foundational document. And that's what this is meant to be. And it's really, really important, which is why it's being negotiated so strongly. And some of the principles, because it will be law. And even if we go back to having an adversarial, non-tech forward regulator like we had for 7 horrible years, it's better to have to argue over a rule than having no rule at all. And so it's going to be fought up until the last possible second. And by the way, even Genius, which for some reason people have whitewashed and said, oh, that everybody was really happy with the first draft. And there were no, that's insane. I remember up until the day it was passed, there was, a split view on its success rate or success probability. So if we fought like crazy over something, over the equivalent of a jaywalking rule, how do we not expect to fight like hell until the very last second this is signed for the most impactful rule and law that will govern crypto forever?
Interesting. How will that affect the average investor?
The protections and the advantages given to the average investor will be defined by this rule. I mean, the simplest one being, will there'll be competition allowed to pay you the highest possible interest rate?
Yeah.
It's really simple, right? Everyone knows. You look at your savings account right now, you're getting under 40 bips if you're lucky. Can we double, triple, quadruple that? And it may not seem like a lot, but 2% versus 40 bips compounded over a lifetime is the difference between retirement and non-retirement. Mathematically, in some instances. It's the difference between being able to afford to send your kids to college in 18 years versus not being afford to send your kids to college after 18 years. 1.6% compounded over 18 to 20 years is massive. When my daughters want something, this is going to make me sound like a horrible dad. I have this little spreadsheet on my phone. And whenever my daughters want to make an impulse purchase, like not something, but if we go into like a store and we get something that they want and then they see something and I want that. This is going to make me sound awful. I pull up this little mini spreadsheet I have and I make them enter into it and it automatically calculates the future value at an investable rate. I use 6% to be conservative.
I love this.
And I say to them, that's how much you can buy this now. You can have that much money when you go to college. I'll give it to you. And what do you want? And if they choose the future value, I make a note in that spreadsheet and it's a tally and I owe them that their first day of college. And it's crazy when you do the math on the difference. When I tweak that 6% up or down a little bit, it's massive over 18 years. So this is really, really, really important for the average consumer. I know that people don't think about it that way. I know that I'm nuts for doing that. You're going to get comments about how I'm abusive, but emotionally abusive, Excel abusive. But it's super, super important.
Yeah, and I think the problem is that people will see the 1.6% number and they'll think that's small. And it's not over time because you do have the compounding factor coming in. Also, you should introduce them to Legos. I don't know; those are appreciating assets, so they should buy Legos.
We had them until I stepped on one, and then now
or it's like a son of a bitch.
Now my favorite sound in the world is when I vacuum one up. Like that little crackle is like ASMR to me. It's like the nails on the box.
All right, so no Legos. Done. No Legos. That's what we're making illegal. We can keep the Labubus, no Legos. Okay, I want to move on to ETFs. Also, you're a great dad, by the way. I think that's a really cool application that I'd like to implement in my future kids. Y'all will be having a spreadsheet and I will be tracking everything. One of the clearest signals that I think people look for in institutional demand is obviously ETF flows. But recently, some of those flows have been a little inconsistent, some strong, some weak. How are institutions maybe interpreting these mixed ETF flows?
Yeah, I mean, look, I think the ETFs, I think, have been remarkably resilient. I mean, if you were to go back in time, go back a year and a half ago and say, okay, we have this Bitcoin ETF. Do you think it's going to be the most successful ETF of all time, or however many years, 2 years, 3 years? Unless you're like Robbie Mitnick from BlackRock, who is the architect of a lot of this stuff, you're probably gonna be like, oh, it'll be okay, it'll be fine. Not the best thing in the world. It'll be fine. And then it blew everything out of the water. then say, okay, now picture a world where Bitcoin gets insanely volatile for periods, doesn't act the way we hope it's going to act, and how will retail react? And if in the off chance this thing's successful, they're going to run for the hills.
Yeah.
And that just hasn't happened. We've seen extraordinary resiliency. So is that from is it that the people buying these ETFs are well informed about the asset and appreciates long-term value? I like to think it is. People always ask me, how should I feel about this volatility? I'm like, well, if you're buying Bitcoin because you think it's a hedge against monetary debasement, against governments printing too much money, which is a very common reason cited. Well, monetary debasement or inflationary practices, those occur over decades. Countries don't destroy their currencies in months. They destroy it over decades. So then your duration, your view of how long you should hold the asset should match the reason you're buying it. So this should be a decades-long vision. Most people don't think that way. But certainly retail investors spot buying ETFs, we don't think of them thinking that way, but maybe we're wrong. Maybe they are. So maybe it's the believers who are buying it. Maybe it's because people bought it expecting the volatility, meaning that it was sold well, it was sold honestly. This is never going to be a boring, muni type asset. But for whatever reason, I'm not going to pretend to know the exact psychology. They've been extraordinarily resilient, and I think I read last couple of days inflows have actually returned. Net inflows have now returned.
Yeah.
So that's encouraging. That's super encouraging. On an institutional basis, I don't see any evidence that institutions are abandoning. I see every time quarterly filings come around, there's some announcement that some new entity owns this massive amount of the Bitcoin ETF now. So, Morgan Stanley's going to kill that launch if they don't have retail demand. So that's your best. They'll shelve it. But that means that what's happening there is their brokers, their advisors, are getting incoming calls, or it's being brought up in conversations, and they're pushing that up the flagpole, and that the decision is made to go ahead with that launch during a crypto winter and during a challenging time.
Isn't there kind of a question on whether capital will expand beyond BTC and BTC ETFs?
It's a great question. It's a really great question. When I was at the NYMEX, it's known for it was the energy exchange.
Yeah.
Right. We had hundreds of contracts. Bunker fuel, which I didn't know what it was when I first joined. That's the fuel that ships run on. Jet fuel contracts, obviously, airlines used to hedge. 90% of our revenue came from natural gas and crude oil. Right. So it's not unusual. Every market has this, right? The Mag 7, there's 10 stocks that represent 95% of the S&P 500's value, or volume. So most markets have a dominant group of contracts, and then just hundreds or thousands or millions potentially with crypto tokens of ancillary derivative contracts. So that's not unusual. That's the same in every single market. So BTC dominance, BTC, Ethereum, a few others, that's very, very normal for capital markets. So it doesn't bother me that you have an inordinate amount of capital flowing in. I view all the other tokens as experiments. And the best analogy I have when my mom asks me every now and then, what the hell do you do for a living? I tell her to think about YouTube. And so when you have an open architecture model, YouTube's kind of like crypto, right? Crypto's open architecture. Anyone with a computer can join.
Yep.
You can become a node, you can become a validator, you can participate in the ecosystem. YouTube is the first way. Anyone can be a filmmaker. Anyone can produce videos, right? The vast majority of stuff on YouTube sucks. It's complete garbage. Vast majority. No, you don't agree?
No, it's brain rot. There's a lot of brain
Exactly. But even before the brain rot concept came around, most of it was just crap because most people aren't good filmmakers, right? That's the most. Most people should not be doing what you do. Like you have talent for it, right? Most people, should not be creating this stuff. So the 99% of it's complete garbage. But then, then Justin Bieber gets discovered. I like Justin Bieber. I'm a huge fan. I'm a believer.
Believers.
It's great. I like that guy. Well, I liked him before. But anyway, he was. But look, he's a great talent, right? So there's incredible talent hidden within YouTube that would never gotten discovered without. You almost need all the crap. I hate to say it. That's the process of discovery. It's just failure. A crypto token you can create in less time than it takes to create a YouTube video, or the same time to create a YouTube video.
Oh,
so
absolutely.
The expectation is going to be that it's a feature, not a bug, that there's a lot of bad experiments, but there are extraordinary experiments buried in there. Stocks have penny stocks, credit has junk bonds. that's just a fixture of innovation. Maybe this will be the one. Maybe I'll be the guest who sucks. You're going to have an amazing career doing this, and you're going to have a bunch of guests who suck. That's just how it works. They're not all going to be gold.
No chance.
So that's how I see it. It's creative destruction. You can't create gold without some of that stuff.
I go back to you mentioned a lot of this like liquidity being kind of sucked and people deploying just shit tokens. I just think about the volume that came onto Solana with people extracting with all these, it takes 10 seconds to deploy a token with no utility, no meaning. And
but the flip side is we have centralized control over on and off ramps. And that's just, look, I mean, the reality is if you list, the first thing you learn when you get your Series 7, 33, 3, whatever, I have all those licenses. One of the first things you learn to get beaten into is that just because a company is listed at the New York Stock Exchange does not mean the SEC thinks that's a good company. That's it. And you know this, right? That's like you get your license taken away immediately. The company gets delisted if they put on their website, we're an SEC approved company, right? That's like they teach you that language is not. So every market acknowledges that to satisfy the characteristics you need to be listed does not mean that the listing entity approves of that business model. That's just not how it works. So we if you believe in the open architecture model, if you believe that's core and essential to blockchain being truly innovative, then that's a cost. The cost is you won't be able to control that onboarding process. And we can do it as an exchange. We can have qualifications you have to meet, but the Solana blockchain can't do that, or it's just not. That's not what we want it to be. That's just a centralized blockchain.
Yeah. Well, would you say, or do you think that institutions are overwhelmingly concentrated on Bitcoin, or are you seeing like meaningful movements into other assets like ETH and I guess maybe not Solana, but?
Actually, I think Solana, give Solana credit. I think part of the reason you're seeing exchanges deep dive and go directly into building side-by-side parallel tokenized equity trading on blockchain, I think we have to tip our hats to Solana, because all of this kind of nonsense that you talked about, which I don't disagree with, it did one really important thing. It proved the resiliency of the infrastructure.
Yes.
The internet was built on cat videos.
Yep.
Right? That's how we prove the pipes work. That's how we prove the compression worked, was just dumb stuff. To this day, and certainly back in the day, the vast majority of internet traffic was just dumb, stupid, not contributing to society, not making people smarter, no utility stuff, entertainment. But it proved the viability of the infrastructure. And now we can send very, very important things over the internet. No different from Solana. When you read about some silly coin going up and down $1 billion over the weekend, what I saw was over the weekend. That's what really struck me. 99.99999% uptime and resiliency. That's what you need to build capital markets infrastructure on. So I don't think, if we didn't have that, I don't know if we'd be so confident, if industry companies would be so confident about entrusting public blockchains to core infrastructure.
This show is brought to you by Token Relations, the leading investor relations platform for blockchains, protocols, and token issuers. You can read the Market Run-Up's weekly newsletter and best investor updates on ecosystems like Solana, Polygon, Avalanche, Chainlink, Aptos, Ripple, and more by subscribing for free or checking it out at www.token-relations.com.
I also have noticed that a lot of people from the Solana Foundation have all left and become absolute outstanding founders of different protocols and other dApps. Like I just had Austin Federa. I'm right. Yes, one of the smartest humans I think I've ever spoken to.
Yeah.
Yeah. There was a point in our interview where he went so technical, my eyes glazed over because I was like, "What are you saying?"
It's like a different language, right?
Yeah. He's a genius, and I really respect him, and I would love to have, I need to get Anatoly and Raj on an episode for sure. But they are wonderful. So I like that you were saying that the chain is very resilient. There's, I think, this like perception and gap between what institutions are doing and what retail like myself maybe thinks is what's happening and what's going on.
Yeah.
What's something that you think institutions are doing right now in crypto that most retail investors like myself are completely overlooking?
I'll go back to the infrastructure comment. They are building out core infrastructure on chain, and whether it's something simple like we're a broker dealer and we want to sell crypto to our clients because they want it, but we're not going to get into the business of building custody and building pipelines and building trading liquidity. So we're going to use Coinbase crypto as a service, just offer that on a straight through pass-through basis or a white label basis. Whether it's retail companies using blockchain to make payments, B2B payments. So there's lots of these pools, like media buying is a great example. I'm learning a lot about this because we're doing a project with a big media buying company. When you buy an ad through Google, it can take 60 days for that money to get in the hands of that small company. That's a real big problem. 30 to 60 days is a lifetime for a small company that's managing cash flow. So to take that down to 10 minutes using USDC is unbelievable. The announcement yesterday or 2 days ago about Fannie and Freddie accepting Bitcoin as collateral, right?
It's huge.
That's the part people don't get. I think that's if I have to say one thing, I hate saying it, I hate when people don't get it. It implies I'm smarter than people. Maybe this part they're not focused on. They're not focused on how when we talk about tokenizing everything, I hate that phrase too, because not everything needs to be tokenized. Eventually, most things will be just because it's better tech. But the real value there is that, yes, it's faster, yes, it's cheaper, that's all great. The real value is getting everything into a system that can speak to each other, because then you can cross-collateralize. That's the real big thing. Because if I have margin tied up, if I'm long X and short Y, and those two systems can't speak. I'm short crude oil and I'm long an equity that's correlated to crude oil on two completely separate exchanges, two separate systems. I have to post margin in both places. I don't get any offsets. That's what institutions care about, is use of capital, freeing it for anyone. And it's not that if you've started a small business, I don't care if it's a coffee shop, personal consulting business, whatever it is, you understand that cash flow is king. That's what kills a business. So how do you supplement your cash flow? You go and borrow. Then you have to pay an interest rate. You have covenants attached to that loan. If you can free up anything, if you can free up some capital that's locked in somewhere, that's the lifeblood of your business. And so we can loan against your crypto assets and provide credit. That's a great help just to entrepreneurs. But arguably, even more importantly, we can free up that margin that just has to sit there for as long as you hold those positions, by getting them on the same system and offering cross margin.
Okay. My cash flow business will be selling Legos.
You use Legos as a big business. You can rent them. You know that? You can rent Legos. Yes, brilliant. Genius. Because kids get tired. So you can rent a Lego set.
Yeah.
Yeah. It's like what's that store that Rent the Runway? Like you rent a dress, right? You can rent. So what happens when you have a kid is the baby industrial complex just hits you. The algorithm hits you with all this stuff to make you feel like a bad parent. And the one thing I will say that I actually clicked on Instagram and used was renting Lego sets, because I'm massively OCD. So accumulating crap would drive me crazy. So you pay a fee, and every 6 month or so, a Lego set comes, and the kids play with it, and then they get sick of it because they built it. And you send them back, and they send you a new one.
And what if one of the Legos dropped? You step on it.
Great question. You have to return 90%. No, you don't.
Oh,
no, they give you a little bit of a wiggle room.
Wow.
Yeah. And if too little come back, then they charge you a little fee.
Could you imagine doing a podcast episode where we're building Legos and having it? No one's done that yet. I'm doing that.
It'd be like Hot Ones.
That's my yes. Yeah. But
and then whoever loses has to walk across the Lego Sea of Fire, barefoot across Legos. And that's how, because that's how people want to see people in pain, right? That's what makes podcasts.
That's why they like watching boxing.
That's why boxing, yeah.
Absolutely. We're onto something.
I like that. Yeah.
Okay, but back to what institutions think about crypto. I know this is the boring part, but I would love to talk about Legos all day. Where does Bitcoin actually sit inside a traditional portfolio? I guess this is kind of a big question. Would it be a hedge? Is it a risk asset, or just something entirely new that people are saying?
That's a great question, because I think we know from research done, and BlackRock put out sort of a seminal paper on this, but others have done the same, that based on the volatility characteristics of Bitcoin, based on generally how it performs vis-a-vis correlation during non kind of massive shocks, Anywhere from a 2 to 5% position materially improves the Sharpe ratio, which is just the risk adjusted. I don't mean to be pedantic. I just want to, if there's non-financial people in your audience, Sharpe ratio is just a fancy way of saying how much return do I get for the amount of risk I'm taking. You want a higher Sharpe ratio. That's the, I mean, you want more return relative to per unit of risk. Although we'll tell your guests, focus more on Sortino than Sharpe. That's really because that focuses on the upside return.
Yeah.
Problem with Sharpe is it measures the down and the up equally. So we know from these really smart people at BlackRock that 2 to 5% position does a really great job of improving the risk characteristics of your portfolio. I think whether you view it beyond that, so it just mathematically it does a great job in that way. I was on the board of a very famous hedge fund called Tudor Asset Management. And they were the first to publish, this is going back 7 years, that they were taking a position in Bitcoin as part, not solely, but part of a better inflation, long-term inflation hedge. If that's your view, that Bitcoin serves as a long-term duration inflation hedge, then it's going to be a higher percentage. If your view is, I love the upside volatility, the Sortino ratio of this asset, and I think it's just going to jam during normal periods, then you can size it a bit smaller because you don't need as much if you believe in that massive upside potential. So you got to make your own decision about how you see its function. You have to decide what your duration is because you don't want to buy any potentially volatile asset that you need to generate cash on a short-term basis. Yeah. Market timing. I've been very, very fortunate to learn from some of the best investors and traders in the world. And the one thing they've all said is they cannot market time. So try to avoid market timing. Pick a thesis, match your duration to that thesis. If it's a hedging vehicle, you can slide up a bit. If it's a risk-on vehicle, perhaps maybe modulate that down a little bit.
I had the CEO and founder of Jito Labs on, and one of the things that you just mentioned that he reiterated, Lucas Bruder.
Oh, okay. It's just Tom from Jito.
Super nice guy.
Yeah, they're
also very smart. All old engineers in their past lives. He brought up launching your product and waiting on this market uncertainty, and he was like, just launch. Yeah. Like literally just launch it. You cannot time the market. It is nearly impossible to time it. You need to get it out there.
Just get started. It's going to be, I saw this recently and it really resonated. Like it's if you think it's too late and you want to wait, if you think it's not the right time and you want to wait, it's going to be even later then. So yeah, just get started. I mean, there's huge advantages to launching during bear markets, right? There's massive advantages people don't talk about, right? You have the ability to buy assets cheap, buy resources cheap. So there's just no right time. I don't know of any entrepreneur who thinks a business succeeded or failed because of like the day they decide to launch. Yeah. I mean, then you're ascribing the whole thing to luck. And I think it's more work than luck.
I guess unless you're launching a token too, then that kind of matters a little bit.
I'd argue if you're launching something that can live or die because of a discrete like monthly period, the probability of it succeeding probably wasn't that high to begin with.
Yeah. I like that. Yeah. Okay, one thing I always try to track is overall risk appetite, and that's something that I talk about in my newsletter frequently because that tends to drive everything downstream. If you had to describe institutional risk appetite in crypto right now, what would that look like?
Institutional risk appetite is materially higher than retail. So I think like the fear and greed index hit its peak like a week or two ago. Institutions, I'd say the institutional index is not so much fear and greed, it's wait or deploy. That's the spectrum, I think, for institutions, because if they've done the work on the asset this is not unusual for crypto. This is like the 9th apocalypse I've been through. So if you're an institution that's studying an asset to deploy meaningful resources to it, and it does a thing that you've seen it do 8 times and always recover better and stronger, you are not dissuaded from that launch. In fact, arguably, you're more encouraged because institutions like predictable behavior. Mm-hmm. And so none of us like these sort of mean reversion moments, but it is a fixture of emergent assets. By the way, AI is no different. AI is not new. AI has gone through peaks and valleys going back 2 decades. So if you were studying AI and you were saying, okay, I'm going to invest in this asset class, and then we're going through an AI mean reversion because it overheated, you're not going, oh, well, this asset class that is doing exactly what it's been doing for 20 years, is doing the thing it's been doing, and therefore I am out. This is silly. So I know almost no institutions that have committed to crypto who are not deploying. They may be deploying in stealth mode a little more because the dollar of value per marketing is a little bit decreased during these periods, but they're still deploying.
Okay.
Well, you're launching your podcast. So this is your 5th episode you mentioned?
Yeah, 6.
Okay.
6 maybe.
So you're launching your podcast during a crypto winter.
Yeah.
Right? Are you dissuaded?
No, because every founder and CEO and person that I highly respect has said, like, listen, price action doesn't matter right now. This is my probably 3rd cycle.
Yeah.
And put your head down, you build. This is the best time to build. Because if you believe in the core infrastructure, like you said, it should not matter what the market is doing. You can build.
I also, I like that, whenever we have a crypto winter, we see companies fail. And that's always sad. But what I'm not seeing are these big frauds, right? That's encouraging. Companies are succeeding or failing based on the merits. It seems like every time we have these winters, we wash out some of the bad actors. So that's one extremely encouraging thing, is no FTXs have been coming out during this winter.
Bye-bye.
Sorry?
I said bye-bye.
Yeah.
What I have seen, though, the companies that do fail, they're trying something new. They'll leave and they'll work on something else in the space, and that's really beautiful.
Oh, we talked about this before the podcast started, right? I mean, there's this failure is a feature, not a bug of entrepreneurship. And you can fail honorably, ethically. I've failed catastrophically throughout my career. And one of the things I'm most proud of is that one of my, if I go to get a job, my primary reference is a guy who invested in a company I worked for that blew up catastrophically 15 years ago. And he lost all of his investment. And he's my number one reference because I didn't run away. I stayed and answered all his questions. He was very, very unhappy with what happened with the company. I was, somewhat junior, but still I was a part of that company. And he's now my biggest reference because he can say, yeah, I lost everything in the company John worked for 15 years ago. But he didn't run away. He gave me his home phone number. I called him and yelled at him 100 times. He always picked up. And after the 100th phone call, that call went from, I'll never forget. He called me one day, it was a Friday, and I was having a really bad day. I was just miserable. And I picked up the phone and I said, hey man, I'm really not in a headspace to be helpful right now. I'm really sorry. And he said, no, I don't want to talk to you about the business. I want to talk to you about, how are you doing? And he's like, you need a break. Come to my house over the weekend. And I remember thinking he's going to probably murder me. And I went, and he didn't talk about the investment at all. Didn't mention it once. I kept waiting. Never mentioned it. Drove home and been friends ever since.
I think that says a lot about you and your good character.
That's flattering. I think I was dumb. I was a kid. I didn't realize today, like my lawyers would tell me what the hell. I mean, I remember I sent an email to all the investors and said, here's my home phone number. Here's my home address. I'm not running away. I'm not going anywhere. It was the right thing to do, but it was a dumb thing to do. So there's some value in just not knowing any better. But yeah, I mean, these entrepreneurs, God bless them. I mean, they have more courage than I do. I never had, we mentioned this too before the show. I never had the courage to I'm an intrapreneur.
Yeah.
I like building things inside
but we
great
need
companies.
We need entrepreneurs.
Not everyone can build their own company. Economies can't work if everybody's selling to each other.
I'm a better 2. I'm finding out that I'm a better number 2 than number 1. I like to report to someone.
I don't think I'm that smart. So like I'm scared if I'm in a room and I'm the only one making decisions. Like I need a smarter person than me to make sure, like metaphorically, my fly's not down. Like that's like, I always think like that's like, what if I'm just dumb and I think what if I'm Dunning-Kruger? Have you ever heard of Dunning-Kruger effect? It's when you're so dumb that you don't know how dumb you are.
Oh God.
That petrifies me. We should all think we have a little bit of it because it keeps you grounded, and sane. Anyway, sorry, I didn't mean to.
No, I know that I have
autism,
but I might have Kruger now also.
Did you say autism?
Yeah. That's why I keep bringing up Legos, I'm pretty sure. Okay.
Let's build a Star Wars set next time we're on.
I'm so down.
Yeah.
And then we'll bring your daughter. She can have her own little set. And then this is perfect.
She'll crush us, by the way.
Oh, yeah, because we have Kruger. Okay, to zoom out, close on the bigger picture, looking ahead over the next 12 to 24 months, what's the biggest catalyst that could unlock the next wave of institutional capital into crypto?
So I hate to be that guy who refuses to answer the question, but I'm going to be that guy only because I think catalysts are crutches to some degree. If you believe in this technology, this asset class, the reason I'm not fazed by any of this is, one, I come from commodities where like the volatility in Bitcoin is nothing compared to natural gas. It's like yawn inducing for me. If you genuinely believe that this technology is better, cleaner, more efficient for transferring risk, value, and information, as I do, then catalysts are just excuses. They're just crutches. So yes, the Clarity Act, a good Clarity Act passing would be great for the sector, but it's going to win regardless. I took my first driverless car in San Francisco.
A Waymo?
Yeah, I took the first one. I was petrified for the first 10 seconds. Then I was like, oh yeah, this is obviously going to win. It made me think about the first time I ever sent an email. I remember the first email I sent. It was slow, clunky. The service failed all the time. But as soon as I hit send, I was like, oh, this is so much better. Like the first time I streamed a movie, I'm like, this is so much better, even though the movie took 6 hours to stream. So, if you believe that, then like you read about, Waymos were like outlawed in XYZ municipality. You just kind of laugh and realize, look, I get it, guys. You're forestalling the inevitable. I understand. You're protecting your system. I get it. The first time I ever went on the floor of the New York Mercantile Exchange, which was open outcry, and I was testing some technology we were building to displace the traders, I got punched in the back of the head and knocked unconscious. Literally, not metaphorically, because they were protecting their kingdom. And they were able to do it for a decade longer than they should have. They were able to protect their kingdom. But the better solution wins eventually. So we traded open outcry. We traded traditional electronic trading. Mm-hmm. Blockchain is that next iteration. So I don't think it doesn't need a catalyst because it's dominant technology. So, but I want to answer your question because that's the right thing to do. I do think a good clarity passing is important. I think the ongoing ETF launches are very, very important. And I think watch very closely Coinbase's and the major equity exchanges 24/7 tokenized asset trading. Because it exists already, by the way. You can trade after hours, but it's fragmented. So if we're successful, we consolidate all that liquidity, then that's transformational. And what's going to happen, not to belabor the point, is once you're able to hedge your exposure to a 2 a.m. event on a Friday night with liquidity, you will never go back. It would be like as if someone told you, look, I think in 10 years from now, theater is going to make a comeback. You're going to go back to having the theater tell you when you're allowed to see the movie. What is the probability of that? No. As soon as you can watch something whenever you want to, you're never going to go back to having a company tell you when you're allowed to do that thing.
Yeah.
So catalysts are what I just said, but I don't think they're crucial at all.
I know you didn't want to answer that question, but that was a great answer, by the way.
Thank you.
Also,
you're really good at this.
Also, Waymos, I love them. I would trust a Waymo more than a female driver.
You're going to get me in trouble.
Sorry.
I can't.
I'm just saying.
I can't agree with that. I have to disagree.
You can disagree. I can say it.
Okay, I have to disagree with that.
I'm a terrible driver. So I personally love Waymo. So
they are. Yes, so safe. Yep.
Listen, I lied. Last question.
Okay.
What is the legacy that you want to leave behind?
Wow.
I know. I ask this every interview. I don't tell them I'm going to ask them. Scaramucci last week said, I don't give a shit. So anything is better than that.
All right. It's on my LinkedIn page. Whoever dies with the best stories wins. That's it. Create wonderful stories for yourself. If that's building and growing up, you're going to be a podcast. More than that, you're going to be a media mogul. If it's that's wonderful. If it's here's what my story wants to be. So I have this little pet project. When my first daughter was born, I had to go to Dubai about a week after, and I was really sad because I didn't want to leave her. And I was at a restaurant, and I saw what was clearly a father and daughter having drinks. Like she was in her 20s and she was laughing. She was so excited to be with him. And I don't know why I got really emotional. I started crying and I sent over a drink to both of them. And they kind of like looked at me weird, and I went over and I said, just could you do me a favor? Like, I want this someday. Like that's the end goal. That's the best story, is my daughter in her 20s or 30s, excited to hang out with me. That's the end game. Could you give me a piece of advice? And they did. I've now done that 226 times in 13 countries. And I'm actually writing a book on all the advice I got from other dads about getting to the goal, the end goal. So that's what I want my story to be. I want my story to be like my daughter's excited to be around me. Not just like, when I go see I love my parents, I love you, Mom, but I'm like, I want them to be like, they're drinking, having a good time. Like, so that's what I want my story to be. So whatever your story is, just build it, just create it. Don't wait. So that's what I want my legacy to be, is helping people understand that whether you want to be an entrepreneur or you want to work in a company or whatever it is, just be the best you can possibly be. Real last thing. I was walking down the street with my daughter the other day, and there was a garbage man who was like having so much fun at his job. He was like flinging bags in over his shoulder, like he was riding on the back of the truck.
Blissful.
And I was, that's what I want, baby. That's what I want for you. Like whatever your path is, like be that guy. Like really, really, really enjoy it. So that's it. That's what I want my legacy to be.
I love that.
Thank you.
That was amazing. Thank you for coming on the show.
Thank you for having me.
That was it, guys. Thank you for another wonderful episode of the Market Run-Up. If you guys liked this episode, please subscribe and get ready for next week's. We will see you then.